Assalamu alaikum wa rahmatullahi wa barakatuh. Bismillahir Rahmanir Rahim. Alhamdulillahi Rabbil Alameen. Wassalatu wassalamu ala nabiyil ameen wa ala alihi wa sahbihi ajma'in. Wa man tabi'ahum bi ihsanin ila yawmiddin. Amma ba'd. Honorable guests, my dear brothers and sisters, this is an honor to welcome you all to this weekly lecture. And today's lecture on analysis of money market instruments and derivatives from Fiqh perspective. And this lecture is a part of our monthly plans and activities organized by Islamic Economics Association of the Faculty of Sharia and Islamic Studies, Kuwait University. And as you know, that we are organizing and hosting international figures, experts, scholars who usually present various types of talks, modules, lectures, and strategies, especially focusing on Islamic banking, finance, insurance, microfinance, capital market, and equity market. And as well as we also focus on some contemporary issues related to Islamic banking and finance, including sukuk, fintech, wealth and debt management, and other corporate banking products and practical contemporary issues, and so on. So today we would like to have our guest speaker, Dr. Salman Ahmed Shaikh. Dr. Salman is the editorial advisory board member, and currently he is a project coordinator and editor in Islamic Economics Project, Pakistan. And he is also editorial advisory board member in Emerald International Journal of Islamic Middle Eastern Finance and Management. Dr. Salman has done his PhD in economics from the National University of Malaysia, UKM, and Masters in economics from Institute of Business Administration, Karachi, Pakistan. In Islamic economics and finance, he has published papers in SSCI, Scopus, and ERA Index journals, along with chapters in books published by Web of Science publishers. He has presented in international conferences, seminars in a few countries like Turkey, Malaysia, Japan, Brunei, Indonesia, and Pakistan. And Dr. Salman is the recipient of 2 Emerald Highly Commended Paper Awards. And he has also editorial advisory board member of Emerald Index in SSCI. He is also editor of Moral Reflections on Economics, which is a monthly periodical published by Islamic Economics Project. So Dr. Salman is joining in a while, in a few minutes. So let's have our video on, our video of Islamic Economics Association. So while waiting for Dr. Salman, thank you.
سعيا لخدمة طلبة العلم والارتقاء بمستوياتهم، يسر نادي الاقتصاد الإسلامي الإعلان عن منصة مدارج لإصدار الشهادات، بوابة خاصة لكل طالب، إمكانية التحقق من مصداقية الشهادات، إمكانية تغيير الاسم. كيف تعمل المنصة؟ بعد حضورك إحدى المحاضرات التابعة لنادي الاقتصاد الإسلامي، يقوم النادي بإنشاء حساب شخصي لك، ثم تصلك رسالة إلكترونية عبر البريد تحتوي على رابط المنصة، اسم المستخدم، كلمة المرور. قم بالضغط على رابط المنصة، ثم أدخل اسم المستخدم كما هو موضح في الرسالة، وأيضا كلمة المرور. ثالثا، اضغط على شهاداتي، بعد الدخول إلى لوحة التحكم الخاصة بك، قم بالضغط على شهاداتي. هنا سوف تظهر لك جميع الشهادات الخاصة بك. بإمكانك الضغط على تحميل لتحميل الشهادة. كما يمكنك تعديل الاسم بالضغط على تعديل الاسم الكامل وكتابة الاسم الصحيح. انتبه، يسمح لك بتعديل الاسم الكامل مرة واحدة فقط. الرجاء التأكد من كتابة الاسم الصحيح. بعد ذلك قم بالضغط على حفظ. كما يمكنك تعديل كلمة المرور وإدخال كلمة مرور قوية. تم تسجيلك في منصة الشهادات بنجاح. مرحبا وأهلا بك في منصة مدارج الخاصة بشهاداتك في نادي الاقتصاد الإسلامي. شارك الآن وارتق معنا بسلم عضويات النادي. نادي الاقتصاد الإسلامي، التأصيل والتميز. من يرد الله به خيرا يفقهه في الدين. ويفهم من الحديث أنه من لم يرد الله به خيرا لا يفقهه في الدين. لتعلم العلم الشرعي في الإسلام فضائل عديدة، ومن أهم الوسائل الحديثة لتدريس العلم الشرعي اليوم التعلم الذاتي عبر شبكة الإنترنت. إذا كنت باحثاً أو طالب علم وحالت بينك وبين طلب العلم الصعوبات والعقبات، إذا كنت موظفاً وتبحث عما ترتقي به في سيرتك الذاتية، إذا كان لديك متسع من الوقت لا تعرف كيفية استغلاله، فإن منصة نادي الاقتصاد الإسلامي صممت لأجلك. يقدم لكم نادي الاقتصاد الإسلامي أكاديمية افتراضية لطلاب العلم من كل بقاع الأرض. منصة نادي الاقتصاد الإسلامي تقدم عددا من البرامج التعليمية الافتراضية المتزامنة والمسجلة. أنشطة تعليمية، بيئة تفاعلية، تقييم دوري، شهادات معتمدة. التحق معنا الآن من خلال منصة نادي الاقتصاد الإسلامي التعليمية وترقى في سلم عضويات النادي.
نادي الاقتصاد الإسلامي لكل طالب علم يبحث عن التأصيل والتميز.
Thank you very much, our technical committee. And distinguished guest, Dr. Salman is trying to join. However, he's facing some difficulties. I think he is joining now. Yes, Dr. Salman. Dr. Salman, can you hear me? Assalamu alaikum. Welcome back. Yeah, I think now it's all right.
Yeah, I am able to hear your voice. Can you hear my voice as well?
Yes, it's clear now. So I already presented my opening remarks, and we also played two videos of our association for the benefit of the guest. So I think now we can start the session. So ladies and gentlemen, let me invite Dr. Salman Ahmed Sheikh to conduct this lecture on analysis of money market instruments and derivatives from Fiqh perspective. So فليتفضل مشكورا.
Jazakallah. Can you share the presentation?
Okay.
If it is possible for you.
Yes, Dr. Sharma, you can start. Just in a minute, I'm sharing the.
All right. Thank you to Kuwait University organizers for again inviting me. And it's always a pleasure speaking on this forum. And Kuwait University has been organizing these webinars on Islamic finance on different topics. And today I got the opportunity to speak on money market in Islamic finance and how does it operate, and what are the different issues with the conventional money market instruments and conventional derivatives, due to which we have to then uh, go for alternate solutions in Islamic finance. So we are going to talk about all these issues in the Islamic money market, and we are also going to look at what are the alternate instruments in Islamic money market which are used in place of conventional derivatives and conventional money market instruments. So I welcome all the participants who have joined in this forum. So let me begin by discussing the outline of my talk first. So if we go to the next slide, we can see that what we are going to be covering. We are going to be getting an introduction of what exactly is money market, and what are the different conventional money market instruments, and what are the issues with those instruments from the point of view of Islamic jurisprudence. So then when we have understood that there are some issues with conventional money market instruments, we are going to look at how Islamic finance sees conventional derivatives. And after discussion on these 2 points, we would discuss that what are the different alternate instruments for liquidity management in Islamic finance. And we are also going to discuss what are the issues in liquidity management in Islamic finance. So this is going to be our outline of the talk today. So moving forward, can we move to the next slide, please? Yes. So when we talk about money market is very, very important in the financial system of any country. The money market is vital for liquidity management, especially for financial institutions like banks. We know that banks have this inherent problem of liquidity, because usually when they provide loans, the maturity of those loans is medium to long term, whereas the deposits which are placed with the banks are having very shorter maturity. In fact, with the advent of digital banking, 24 hours, 7 days a week, you can do transactions online through ATMs, through digital banking platforms. So the money which is deposited into banks in the current account, in the saving account, can go at any time of the day, any time of the night. So usually banks have about 33% to 50% of their deposits which are placed without any binding restriction, that you cannot withdraw your money which you have placed with the bank. So the deposits which are placed with the banks constitute uh, two, you can say, categories of accounts. One is checking account and one is non-checking account. The checking account has this feature that you can withdraw your money anytime you want. So only half of the deposits, or maybe even less than that, are basically placed with the bank with some maturity. And usually the maturity is also very short term, few months to just 1 to 2 to 3, or maybe maximum 5 years. In some accounts, you might see that the deposits are placed on longer term basis, maybe 7 years and 10 years. But these deposit accounts are very small in number, and a very small portion of the deposits is placed with long term focus. Whereas banks, when they provide finance through lease, through mortgages, and usually the maturity in these contracts is very long, or at least medium term. So banks have this problem that they have to manage their liquidity, and they work on fractional reserve banking principle, which means that the amount of money that they have, they loan out a much larger proportion in comparison to that. So they work with the fractional reserve banking system, meaning that the actual money that they would have would be much lower than the amount of loans that they have provided. So when they face this problem that their loan portfolio is not performing well, there are some non-performing loans, or they are not getting enough returns on their loan portfolio, then they might face some difficulty in providing returns to the depositors, and also honoring the withdrawal request when they come. So they have to manage liquidity, and money market is a mechanism through which they can engage into different short-term transactions, and these transactions usually have a very shorter maturity. That is why we say that money market is a place, or is a mechanism through which financial institutions engage in short-term uh, exchange of funds. So in order to manage the liquidity, both in terms of shortage of liquidity as well as when there is surplus liquidity, there is need for liquid instruments. So sometimes there might be a need that a particular bank is short of funds. That is also a liquidity management problem. And if a particular bank has surplus liquidity, like most of the Islamic banks in many jurisdictions usually have this problem, because they don't have many variety of conventional money market instruments to basically engage in. They cannot trade in treasury bills. They cannot do transactions in reverse repo or repo transactions. So they cannot invest in corporate bonds and so on. So usually they have much less room to play with their liquidity. So they have this issue that they usually would have surplus liquidity. This is also a liquidity management problem. We would not say that this is an ideal condition, because if you are keeping your capital as idle, and if you are not basically making it usable, and if you are not generating returns on that, then it might affect your profitability, because you would not be getting enough returns on your idle capital. So once banks have surplus liquidity, they also need to invest it. And when banks have shortage of liquidity, they also need to source finance. And when they have to do it on an urgent basis in very short term time period, so in that case, they basically engage with different financial institutions in the money market. For Islamic banks, managing liquidity in the money market is even more crucial. Why? Because they have more regulations to follow, including Sharia compliance regulations. So they have to follow the central banking guidelines. They also have to follow the Basel guidelines. And then on top of that, they also have to follow the guidelines related to Sharia compliance. So they have to ensure that they are able to manage liquidity in an effective way, but they also have to ensure that they do it in a Sharia compliant way. So for them, liquidity management becomes a even more challenging task, or a more important task. Can we move forward? All right, so now we are going to discuss one by one that what are the conventional money market instruments which are used in the conventional money markets, and what are the issues in these instruments related to Sharia compliance. So first we take the most important instrument, and I think it is there in almost all the countries, in all the markets. It is called the Treasury Bill. Treasury Bill is a instrument of uh, instrument of finance used by the government, and it's a zero coupon bond. It's a zero coupon instrument, meaning that there is no explicit payment of interest in this instrument. But it does not mean that if there is no explicit interest payment, it is interest free. It is not interest free, because interest is implicit in the nature and structure of Treasury Bill. So Treasury Bill is an instrument through which government borrows money on short-term basis, usually from financial institutions, and in some markets, retail investors, meaning the individual investors, are also allowed to participate in investing in the Treasury Bill. So what is Treasury Bill? It's a zero coupon instrument, meaning that it does not pay interest explicitly, but there is implicit interest involved in this transaction, and we are going to look at how. And it is issued by the government. It is issued by the government. The issuer would always be government. So when we use the term treasury with some instrument like treasury bill, treasury bond, usually this refers to the sovereign instruments which are issued by the governments. Treasury bills are short-term instruments, and they are issued with maturities ranging from 1 month to 1 year. So treasury bills are issued with maturity of 1 month, 3 months, 6 months, 9 months, and 1 year. and more or less this is very much the norm across different financial markets. Now, the holder of a treasury bill is not entitled to any coupon or interest payment. That is why it is known as zero coupon or zero interest instrument. But it does not mean that it does not have any interest. It's just that it does not have explicit interest. So this point is explained in the next bullet point. However, having zero coupon payment or no explicit interest payment does not make this instrument halal. So if there is no explicit interest payment, it does not mean that it is interest free. How interest is involved? To compensate the buyer of the instrument, these bills are sold at a discount from par value. So suppose that treasury bill has a par value or a face value of let's say 100 real. Now when it is sold to the buyer in the primary market, what will happen is that it will be sold at a discount. It will be sold at, let's say, 90 real. So the 10 real discount is basically the benefit to the buyer. The buyer can redeem the treasury bill on the maturity date by handing over the treasury bill to the issuer, which is government, and get back the whole par value, the full par value, which is 100 real. Whereas when the buyer bought the treasury bill, the price paid would have been a discount from the par value, and the difference between this discounted price and par value is basically the implicit interest which is going to the buyer of the treasury bill. Now, how government benefits from it? Government benefits from it because it is getting liquidity, getting borrowing. After issuing the treasury bill, it gets the money, which is, even though uh, having a discount from the par value, but it is still providing a funding facility to the government. And when the maturity comes, the government would redeem the instrument, would give back the full par value to the buyer who bought the instrument. And there is a very active secondary market for that. And basically, the secondary market in which these treasury bills are traded is basically the money market. So at maturity, the buyer who is a financier to the government is entitled to receive the face value of the treasury bill, as I have tried to explain. Can we move to the next slide, please? So it involves an exchange of money with a time difference. Any difference in counter value is riba. So we know that what is riba. In riba, what happens is that you loan out money in one time period, and then the borrower has to pay back the money back at a different time period. So there is exchange of money at two different time periods. Now Islamic principles say that when that happens, you cannot have difference in counter value. You cannot have this transaction that you are loaning out, let's say, 1,000 real, and you are getting back 1,200 real. If you would do that as a condition, as a stipulated increase over and above the principal amount, then this would be the difference would be termed as riba. So in treasury bill, what happens? The issuer issues the treasury bill at a discount from the par value, let's say at 90 real. And when the treasury bill matures, the issuer is going to buy back the treasury bill at the full par value, 100 real. So this 10 real difference is basically riba. So basically, it's like a same transaction that you have loaned out $90 to the government, and when the treasury bill is maturing, you are getting back $90 with $10 of interest. So if we take, let's say, real as currency, $90 real have been lent to the government, and the government has to pay back 100 real at maturity. So this 10 real difference is basically the riba, even though it is not paid explicitly, but it is still there in the transaction. So that is one problem with treasury bill. One very important and big problem with treasury bill, because it involves riba. It cannot be compliant with Islamic principles. When the buyer of treasury bill pays discounted price to the issuer, the discounted price of the treasury bill is the money loaned to the government. So the 90 real is basically the loan which is given to the government by the institution who is buying the treasury bill. And at maturity, the buyer receives more than what it loaned out. So it receives an excess. It receives the full par value, which is more than the discounted par value at which it bought the treasury bill. So the excess is basically the increase, and this increase is riba in Islamic principles, because any predetermined and stipulated excess in a loan transaction is riba. Hence, due to the involvement of riba, this instrument is not permissible as per Islamic principles. So this is very important to understand that treasury bill, even though it does not have any explicit interest payment, it is still not compliant with Sharia principles. And because it is not compliant with Islamic principles, Islamic banks or Islamic mutual funds cannot invest in treasury bill, not in the primary market and also not in the secondary market. Can we move forward? So another transaction which is very common in conventional money markets is repo and reverse repo transaction. So repo and reverse repo transactions are basically opposite transactions, or you can say that it's the same transaction, but repo is taking a perspective of one counterparty, reverse repo is taking the perspective of another counterparty. So whenever trade happens, um, it's a sale transaction for the seller and it's a buying transaction for the buyer. So same is the case with repo and reverse repo. So these are not two different transactions. Basically, the same transaction has two counterparties. For one counterparty, it's a repo transaction, and for another counterparty, it's a reverse repo transaction. Now, what happens in repo and reverse repo transaction? Basically, in repurchase agreements or repos, what happens is that a financial institution is having need for funds. So what it will do is it will say to another financial institution who has surplus liquidity, it would say to that financial institution that, okay, I have treasury bill, I can sell it to you. You buy from me at a discounted price, and then I will buy it back from you. I will repurchase it from you after some time period, and I would repurchase it at a higher price than the price at which you have bought from me this treasury bill. So the difference in price would be basically interest income for the one who is buying the treasury bill in the first transaction. So in repo transaction, what is happening is that there is a buyback transaction. So there are two problems with repo transaction. One is that it's buy ina, it's a buyback transaction. So buy ina is not allowed in Islamic finance. Why? Because it opens the door to riba. It opens the door to riba. If we allow buyback transaction, then what will happen is that you can structure any interest-based transaction on the format of a buyback transaction. You can structure any loan transaction in the form of a buyback transaction. For instance, if let's say I want to borrow 10,000 real. So I want to borrow 10,000 real. One way is that I borrow it from bank, and bank would say to me that, okay, we are going to give you 10,000 real for 1 year. And after 1 year, you have to pay back with interest, and you have to pay 11,000 real. Now this 1,000 real is basically interest. So what you can do with buyback transaction is you can achieve the same end, you can achieve the same purpose, same economic purpose of this transaction by simply using buyback transaction. How? Let's say if I have a car and that is worth 11,000 real. So what I will do to the financier or to the lender is that, okay, I have a car, it's 11,000 real worth, and I will sell it to you at 10,000 real. So you buy it from me at 10,000 real, and after 1 year, I will buy back my car from you at 11,000 real. So you would again get 1,000 real as income, and it is predetermined. So buyback transaction is not allowed because of this, that if you allow buyback transaction, you can structure an interest-based transaction through the buyback structure. So in repo transaction, what is problematic is that it involves a buyback transaction. It involves the selling of treasury bill and buying back, repurchasing it again in the second leg of the transaction. So one problem with repo is that it's a buyback transaction. Another problem with repo is that the underlying instrument is treasury bill. And Treasury Bill, as we have seen in the previous slide, is also Sharia non-compliant. It is also not compliant with Sharia. So there are two problems with the repos. One is that it involves the buyback transaction, and second, the underlying instrument in repo transaction is usually a interest-based security in which trading or exchange is not allowed. So this is one problem with repo. So repo is a transaction of financing from the perspective of the counterparty or financial institution who is selling treasury bill at a spot and repurchasing it back in the second leg of the transaction. And for the other counterparty with whom this transaction is done, this repo transaction for the other counterparty would be considered as a reverse repo transaction. So this is about repo transactions. So it is also not compliant with Islamic principles because of two, you can say, major problems in this transaction, in this instrument. One is that it involves a buyback transaction structure. The other is that it involves the underlying instrument which is not compliant with Islamic principles. Can we move to the next slide? So we have discussed two instruments so far, Treasury Bill and Repo transactions. Both are not Sharia compliant. Now, what about corporate bonds or coupon bonds? Now, coupon bonds are simply interest-bearing securities. They involve explicit interest. The difference between a coupon bond or zero coupon bond is that in zero coupon bond, the interest is implicit, whereas in coupon bond, which are usually issued by the corporations, so they are also known as corporate bonds, they involve explicit interest. So what is the rationale of issuing corporate bond? The rationale is that when you would borrow from bank would take its spread as well. So if, let's say, banks have to pay 5% interest rate to the depositors, they would charge from their financing side clients more than 5%, because the difference between the lending rate and deposit rate would be a spread. But if, let's say, you are a corporation and you are looking to get finance, you would think that, well, if banks are borrowing from the depositors by paying them 5% interest rate, why don't we directly borrow from the investors? So some corporations which have huge, let's say, size, reputation, as well as history, as well as goodwill in the economy, they might look to issue certain instruments like bonds, which would be priced at a level at which anybody can invest. So for instance, if, let's say, I am issuing a bond with 100 real face value, so many people in Kuwait would be able to basically have investment of 100 real in a bond. So these corporate bonds would be priced at an attractive face value, so that many people can participate in the investment process. And then the idea is that you generate funds from a larger pool of investors. And sometimes what happens is that banks have asset liability management problem. They have shorter maturity deposits and they have longer maturity loan portfolio. So they would not be willing to lend for longer maturities. Let's say if you want to invest in a very huge project in which break even would be reached after several years, you would want to have long term financing of, let's say, 10 years, 15 years, or maybe even beyond 15 years. So in that case, corporate bonds are very useful, because you are not restricted by the asset liability management problem which banks have, and you are also not restricted by different prudential regulations under which banks operate. So banks have to operate under certain prudential regulations which say that you cannot take exposure to a particular company or to a particular industry beyond a particular percentage of your loan portfolio. So when big amount of funds are required, large amount of funds are required for longer maturities, then corporate bonds are very useful. So they have an economic rationale for existence in the financial markets, but the problem with corporate bonds is that they are interest bearing instrument. So what the corporation does is it issues bonds at a particular face value, and periodically the issuer of the bond, the corporation who has issued the bond is going to make coupon payments, and these coupon payments are going to be made at a particular rate of interest, and that rate of interest is known as coupon rate. So these coupon bonds are basically interest bearing securities, because when the issuer is issuing the bond, it is basically borrowing from the investors. And after the issuance of the bond, periodically, after every 6 months or 1 year, the issuer is going to make coupon payments, interest payment to the investors. So the investors are getting something over and above the principal amount, which is interest, which is called coupon. But in Islamic finance, it would be considered as riba, because in any loan transaction, if anything is asked from the borrower with a stipulation, with a condition, so anything charged over and above the principal amount would be considered as riba. So in corporate bonds, this is the problem. That is why these instruments are also not Sharia compliant. Yes, brother Muhammad Tawfiq, I think has a question. Should we take questions now, or should we take it at the end?
It's your choice, no problem. If you want
Yeah,
to take
yeah.
questions.
If Muhammad Tawfiq has a question related to this slide, then maybe we can
Oh,
take this
okay,
question
I will
right now.
switch on microphone for him. Brother Tawfiq, Muhammad Tawfiq, please. Brother Muhammad Tawfiq, you may speak now. I already switch on microphone for you. I think he mistakenly raised the hand, I guess.
All right.
Okay, you
All
may
right.
continue.
So can we move? Yeah. Can we move to the next slide? All right, and now we look at certificate of deposits. Now these certificate of deposits are special accounts created by different corporations in the financial institutions. So what they are looking for is an opportunity to get interest payment on their surplus liquidity. So what happens is that corporations usually have a cash conversion cycle, which is seasonal, and sometimes they would be short of liquidity when they have to make procurement, when they have to make different payments. But when they have done the production of goods and they have sold those goods in the market, they would get cash. So when they would get cash, they would have surplus liquidity. Now there could be shorter time periods in which they have surplus liquidity and they do not have any ways to invest it in their core business. So in that case, they would be willing to invest, let's say for a week, for a few weeks, or for a month or few months to get return on their surplus liquidity. In that case, they are looking for different investment options. Now, financial institutions like banks, they offer certain attractive certificate of deposits schemes. They say that, okay, if you would place a very large deposit, then we are going to give you a preferential rate. We are going to give you more interest rate. We are going to give you profit at a greater rate as compared to the rate that they pay on the normal deposits. So if, let's say, there is a normal deposit within the range of few thousand real, the interest rate is 5%. But if you would invest a few 100,000 reals, or maybe few million reals, then the interest rate could be a preferential one, which is offered to you. It could be 7% or 8%. So these are certificate of deposits. They are also offered to the retail investors, meaning the individuals, and they are also offered to different institutions, including financial institutions and non-financial institutions. So in these certificate of deposits, there is a clear problem of interest, because interest is involved explicitly. These certificate of deposits are interest bearing. They are remunerative deposits which are placed with financial institutions, and there is an interest paid on them, which makes these instruments Sharia non-compliant as well. And because the instrument is Sharia non-compliant, so it does not matter whether you are investing in the instrument in the primary market or in the secondary market, or you are just making a transaction in which this financial asset is underlying. All of these transactions would be considered as non-compliant, because the instrument is non-compliant. So if you're taking any position in the instrument from the buyer side, from the selling side, it would not be considered as Sharia compliant. All right. So can we move forward? All right. What is commercial paper? Commercial paper in its structure is just like Treasury bill. In its structure, it is just like a Treasury bill. The only difference is that Treasury bill is issued by the government and commercial paper is issued by the corporation. So commercial paper is issued by the corporation and they are trying to get loan through this instrument, and it also has implicit interest involved, just like in Treasury bill. So for the reasons which we have discussed, due to which Treasury bill is Sharia non-compliant, the same reasons apply to commercial paper as well. So commercial paper is also not Sharia compliant because it implicitly involves riba. It implicitly involves riba. So commercial paper, like Treasury bill, is also not compliant with Islamic principles. So we have discussed different conventional money market instruments which are not compliant with Islamic principles. Treasury bill is not compliant with Islamic principles. Treasury bond is not compliant with Islamic principles. Repo transactions, reverse repo transactions are not compliant with Islamic principles. Different kinds of certificate of deposits and commercial paper, these are also not compliant with Islamic principles. The discounted bills like bill of exchange discounting, this is also not compliant with Islamic principles. So all of these conventional money market instruments or transactions have an issue when it comes to Sharia compliance. Can we move to the next slide? Now we are going to look at what about conventional derivatives. So there are different derivatives which are used in the money market. Uh, they are forward contracts, future contracts, option contracts, and swap contracts. Now there is an issue with these derivatives as well. There are in fact multiple issues. If we take forward contract is a contract. It's a private agreement between two parties, giving the buyer an obligation to purchase an asset and the seller an obligation to sell an asset at a set price at a future point in time. Now, Islamic rules of sale say that when you want to make a sale transaction, you have to execute it. You cannot keep it open. You cannot direct it towards some future time period. Yes, when you have concluded the sale transaction, it is not necessary that payment has to be at spot as well. Islam allows spot sale as well as credit sale. But credit sale is also a sale which is executed at spot. Only the payment feature in the sale is deferred to future, but not the sale itself. The sale is concluded and executed at present at a spot. So Islamic rules of sale say that when you want to make a sale, then you need to make a sale. You cannot leave it open. You cannot direct it towards the future, because when you would do that, it would create uncertainty, and it would not be considered as Sharia compliant. So Islam allows spot sale, cash sale. Islam allows credit sale. Islam also allows salam sale, which is a sale in which sale is executed at present, and the payment is made fully at a spot, but only the delivery is deferred. But if you defer the delivery as well as the payment as well as the execution of sale to some future time period, then this is not allowed as per Islamic principles. Now, forward contracts are used for different purposes. They are used for hedging purposes, which is the purpose of risk management, and they are also used by speculators to basically try to make a short-term gain by just playing with the differential in prices. So if let's say there is a genuine need for risk management, we have a salam contract, which we are going to discuss in next slides. But the forward contract, as it is done in conventional money market or in conventional financial system, is not compatible with Islamic rules of sale, because Islamic rules of sale say that you have to execute a sale transaction in the present time period. Yes, payment can be deferred. Yes, delivery can be deferred, as in credit sale and also in salam sale, but you cannot keep the whole transaction directed towards future. So that is a problem with forward contract. Now, there is another contract in conventional financial system, and it is also a derivative contract, which is known as futures contract. Now, the difference between futures contract and forward contract are three. One is that forward contract is a private agreement, so it is customizable, whereas futures contract is non-customizable. It's a standardized contract. Forward contract, because it's a private agreement, it would be done over the counter, meaning it would not be done over the exchange. It would be done over the counter, meaning outside of the exchange. Whereas futures contract is traded on exchange. And another feature which is different in forward contract and futures contract is that in forward contract, usually delivery is there, meaning that at the time when you are concluding the sale based on the forward agreement, delivery would take place. Whereas in futures contract, usually the delivery would not take place. There would simply be a settlement on cash basis. There would be a net cash settlement. There would not be any delivery. So meaning that futures contract are basically not done with the purpose of risk management in most cases. They are done with the purpose of speculation. So the institutions which are involved in futures trading are just trying to make short-term gains through investment in futures contract. Now, again, in futures contract, the same problem is there. Islamic rules of sale say that you cannot have a sale transaction which is directed towards the future. When you want to make a sale transaction, you have to make the sale transaction. Yes, payment can be deferred as in credit sale. Yes, delivery can be deferred as in salam sale, or both payment or delivery can be deferred in an exceptional istisna sale in which asset cannot basically come into existence before the sale. So Islam allows these exceptions, but it does not allow that in the normal scenario, you defer the payment as well as delivery, as well as do not conclude the sale transaction at present, and you direct it towards the future. So futures contract also have this problem with respect to Sharia principles, that they do not follow the Islamic rules of sale. So moving forward, we can discuss the third derivative, which is options contract. Now, sometimes there are certain transactions in which a huge amount of funds are required, and you would not like to commit your capital, your sum of money in those huge transactions. So, for instance, if there is a transaction involved in which you have to pay millions of real, so you would not want to commit to the transaction, but you would want to hedge your price risk. So options is a way to hedge price risk without committing to the sale transaction, without fully paying the sale price. So you would not like to pay the whole price of, let's say, a certain asset which is in millions of real, but you would still like not to be having higher price in future. So you would want to hedge against higher uh, price in future. So one way you can do that in conventional financial system is that you enter into a options contract. Now options are contracts uh, which come in two varieties: call option and put option. Now, an option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specified date, depending on the form of the option. Now, there are two option contracts. One is American option contract and one is European option contract. In American option contract, the option can be exercised at any time before or at the maturity date. Whereas in a European option contract, the option can be exercised only at the maturity date. Now, in terms of the structure of the transaction, there are call options and there are put options. Call option gives the option to buy. On the contrary, put options give option to sell. So there is an option involved. You do not necessarily need to buy. If you are buying a call option, you are not necessarily going to buy the asset. You will have the choice up to a certain time period. And if you let that choice expire, it's up to you. You do not have to commit your whole funds to buy an asset. Likewise, when you are buying a put option, you have a right to sell at a particular price um, for a particular time period. And when the time period expires, when the put option expires, then you no longer have that choice. So again, in the call option and put option, you would have the choice to buy and sell, but you would not have an obligation to buy and sell. You may decide not to buy, not to sell, depending on the situation at the time of maturity of those contracts. So for instance, if let's say you want to hedge against the price increase, you would take call option. But if let's say the market price is already very low at the maturity date of the options contract, in that case, you would let the option contract expire. For instance, if let's say you are buying, let's say, a commodity at 10 real now, and you think that the price may increase to 15 real 1 year from now. So you might want to enter into an option contract which gives you the option to buy that commodity between 10 to 15 real 1 year from now. But if let's say after 1 year elapses and the same commodity is trading at 10 real or maybe 9 real, so you no longer have to exercise your option, because already the market price is much lower than the price at which you have the option to buy. But by buying option, you are hedging against the price increase. Buying by entering into call option, you are hedging against price increase, and when you enter into put option, you are hedging against price decrease as a seller. So these are options. There is an economic or financial sense in the use of these instruments. But what is the problem from the Sharia perspective? The problems, we are going to discuss that. So again, this slide is saying that when you have call option, there are going to be two counterparties. One is the counterparty who is selling you the call option. So that party is going to be known as the call option writer. It is the counterparty which sells the call option for a call price, because this option would not come at no price. Because if you would be able to buy call options without any price, you would then try to buy call options for every price and for every maturity date. So there is a price involved, so that call option writer also has some financial gain. So call option writer has the obligation to sell the asset if the call option buyer decides to exercise the option. So in options, what happens is that one party has an option, but the other party is committing to the transaction, is providing the commitment. So call option writer provides this commitment that if call option buyer exercises the option, he would be ready to support the transaction and execute the transaction at the strike price. Strike price is the price at which the option can be exercised. And what is call price? Call price is the price which you pay to get the option. And same goes with put option. There is a put option writer. It is the counterparty which sells put option for a put price, and put option writer has the obligation to buy the underlying asset if the put option buyer decides to exercise the option. So this is all about, you can say, options contract in a nutshell. Now, moving forward, if we move to the next slide, we are going to look at what are the issues from the perspective of Islamic jurisprudence. From the perspective of Islamic jurisprudence, the problem with options is that there is no valuable subject matter involved. There is no commodity involved. There is no sale of a valuable subject matter. There is just a promise from one party, and promise in Islamic jurisprudence is not a commodity which you can trade. You cannot trade promises. So there is no asset involved. There is just a commitment involved, unilateral commitment involved, and it cannot be sold for a price in Islamic jurisprudence. Thus, it is impermissible to sell options for a put or call price. The put and the call price are not permissible as consideration for the provision of merely an option. So merely providing an option or providing a commitment or providing a promise for a price is not allowed, because this is not sale of an asset or a commodity which is considered as valuable subject matter in Islamic jurisprudence. It is different from a sale transaction where an advance payment is made to mitigate the risk of the buyer backing away from the contract. So usually what happens is that when we go to buy cars in second hand market, or when we go to buy houses, we have to make a down payment. So this down payment is different from options. In down payment sale, what happens is that you are making some down payment, which is advance payment, and it is used in those contracts to mitigate the risk of the buyer backing away from the contract. In options, the sale may or may not be executed. So in advance payment sale, basically the sale is executed and you have made some advance payment. But in options, it's not that you are making a sale. You are just entering into an options contract. You may buy or sell the asset at the exercise date, at the maturity date, and you may decide not to basically um, exercise the option. So the sale is not taking place. Sale is not taking place. So at the time of entering in option, no sale of underlying asset takes place. Thus, it is a contingent sale or no sale. Contingent sale meaning that if the buyer would decide to exercise the option, then there would be sale executed. But if not, then the sale is not going to be executed. So meaning that the sale is not executed, it is dependent, it is contingent on some future event and on future date. And this is not consistent with Islamic rules of valid sale, which say that when you have to make a sale, you have to make a sale. You have to say that you are making a sale, and you cannot direct it towards the future. You cannot leave it contingent on some event. So that is the problem with options contract. Now moving forward, we are going to look at the last derivative from the conventional perspective, which is swap. Swap is basically just like the name says, it's a swap of two different loan contracts. So let's say there is one party which has taken a loan on fixed interest rate, and there is another party which has taken a loan at a flexible or floating interest rate. So what they would like to do is that if, let's say, they expect the interest rates to change in future, and they have opposite expectation. One party is expecting the future interest rate to be higher than present, and one counterparty is predicting that the future interest rate are going to be lower than the present. So they have a opposite expectation about the future interest rate, but both think that the interest rates are going to change in the future. So what they will do is they would like to swap their interest liabilities. So the one which is having a fixed rate loan would want to go for a floating rate loan, and the one which is now having a floating rate loan would want to go for a fixed rate loan. So the expectation is that when they would do this swap, they are going to be better off. Both think the same way. So these swaps are also used in the financial market. The problem with swaps is that the underlying instrument of sale is a interest-based transaction. So that is one problem, that the underlying contract is not Sharia compliant. And then when it comes to swapping of debt, Islamic rules of sale say that because debt is just a non-compensatory contract, there cannot be any charge on the debt contract, there cannot be any profit on the debt contract. So you can only assume the debt at the same face value. There can be just exchange of debt at the same value. But if, let's say, debt is exchanged at a different value, then there would be riba involved. There would be riba involved. So debt can only be assigned or exchange at the same par value. But if the value is going to be different, then the transaction is going to include riba. So swap is not Sharia compliant because the underlying instrument or the underlying contract is not Sharia compliant. It is usually interest-based loan. And when these loans are exchanged at different values from the par value, then again, riba would also be involved in such exchange. So swap is not allowed for this reason. All right, I think we can move forward. So so this is one example. I think you can read that because you will have these slides later on as well. Now, let me move on to Islamic money market instruments. Now, this is one summary from the discussion so far. So we have looked at different financial instruments: treasury bills, repo transactions, reverse repo transactions, corporate bonds, forward contracts, futures contracts, options, swaps, certificate of deposits, and what are the issues from the Fiqh perspective of, or from the Islamic jurisprudence perspective. These are summarized in the second column. So I would not like to repeat it because we have already discussed that, but it's a good summary table which you can look at later on. Now, moving forward, we are going to look at what are the Islamic, you can say, money market instruments which can be used. In place of corporate bonds, what Islamic finance offers is the contract or the instrument of sukuk. So sukuk are instruments which are issued by both the government as well as corporations, and they are alternate of treasury bills, treasury bonds, or corporate bonds or commercial papers. So sukuk are basically instruments of finance in which you are using the market to generate finance. But you cannot have the underlying contract which is based on qarz. You have to involve some, let's say, underlying Islamic finance modes of financing, for instance, ijara, for instance, istisna, salam, mudaraba, musharaka. So there are different sukuk based on which underlying Islamic modes of financing they use. So there are sukuk like ijara sukuk, mudaraba sukuk, musharaka sukuk, istisna sukuk, salam sukuk, murabaha sukuk, hybrid sukuk, bakala sukuk. I think those of you who have taken my previous webinar, that was on sukuk. So I think already some of you would be familiar with what are sukuk. So these sukuk can be traded in the secondary market as well. So secondary market is where the instruments are traded after the issuance, and when they are traded at the time of issuance, we call such transactions as primary market transactions. So Islamic financial institutions like banks and mutual funds can invest in sukuk to earn return from the underlying asset. In ijara sukuk, the sukuk holders earn a return based on rents coming from the lease for the use of assets jointly owned by the sukuk holders. So I think you must be familiar with the structure of sukuk. So in ijara sukuk, what happens is, let's say there is a corporation who is originator, who wants to, let's say, build a plant, and it needs finance to build that plant. So what it would do is it would issue sukuk through an SPV, a special purpose vehicle, and this special purpose vehicle is going to issue the sukuk to the sukuk holders. Now, sukuk holders, after buying the sukuk, would become the joint owners of the asset, which is going to be financed by the SPV for the originator. So SPV would buy the asset and it would give it on lease to the originator, and the originator is going to use that asset and pay rent for the use of the asset to the SPV, and SPV would use these rents to make profit payments to the sukuk holders. So this is the typical structure of ijara sukuk, which we have discussed thoroughly in the previous webinar, and I think the recording is available. You can also look into that as well. So in place of treasury bill, in place of corporate bond, in place of commercial paper, in place of treasury bond, what Islamic finance offers is the instrument of sukuk. Now, those corporations or individuals who want to, let's say, take on greater risk and they want to have greater return, they can also invest in Sharia compliant stocks. So Sharia compliant stocks are also very important option in placing the funds in a Sharia compliant way. Now, some of you might have this observation or this question that stocks are instruments which do not usually have maturity. We talk about preferred stock or common stock, they do not have any maturity, so they are usually termed in the capital market frame. But here, when we are saying that in money market transactions, you can invest in Sharia compliant stocks. It's about the investment horizon. So if let's say you have a very active secondary market of Sharia compliant stocks, so what you can do is you can invest in Sharia compliant stocks for a very brief period, maybe for a few days, for a few weeks, for a few months. So in that case, you are still managing to get the economic need fulfilled, which is to invest in short term time period and to get some return out of that. And you do not have to keep on invested with the stocks, because you can always liquidate your investment by trading in the secondary market. So you do not necessarily have to keep the stock which you have bought forever. You can definitely revise your portfolio, and you can disinvest your investment in the Sharia compliant stocks when you think that your investment horizon has matured and you want to get back your money. So Sharia compliant stocks are also very important options, and these are also important in some countries where treasury bills are not available, as well as sukuk are also very limited. So in some parts of the world, previously governments have allowed Islamic banks to invest in sovereign stocks, meaning the stocks of government owned companies. So central bank has allowed that in place of treasury bill, Islamic banks can invest in sovereign stocks, which are Sharia compliant. So in that case, they would still be, let's say, um, investing and getting some return, and the central bank would be able to achieve the objective of mopping up funds when it wants to, let's say, contract the money supply. All right, we can move forward. All right, another arrangement which is done in some countries, like in Pakistan, is interbank pool management using Mudaraba. So Mudaraba is a contract in which there are two partners. One is Rabul Mal, the other is Mudarib. Rabul Mal is the investor who invests funds. Mudarib is the partner or investor who brings expertise to the partnership, but who does not invest funds of his own. So they agree to a pre-agreed profit sharing ratio, and they undertake a business activity. And when that business or productive enterprise earns some profit, so the profits are going to be shared as per the pre-agreed profit sharing formula. And if there is loss, the loss is shared between the partners based on their capital contribution ratio. Now, Mudaraba can also be used between financial institutions. So what happens is that in interbank pool management using Mudaraba, Islamic banks would invite, let's say, other Islamic banks and conventional banks to participate in the Mudaraba partnership, and Islamic Bank would be selling some of its financing assets to the Mudaraba pool. And from this Mudaraba pool, if returns are generated, then these returns are going to be shared between the financial institutions. So this is also a very important, you can say, mechanism through which funds can be placed in the money market. So in some jurisdictions like Pakistan, it is being used with success. There is also interbank pool management using Musharaka. So Musharaka is a partnership in which both partners can invest and both partners can provide their expertise. Whereas in Mudaraba, there is a distinction of role. The investing partner is just the investing partner, and the working partner is just the working partner and does not invest funds. Whereas in Musharaka, both the capital contribution and the fund management can be done by both partners or all partners as they may decide. So interbank pool management using Mudaraba and Musharaka is also very interesting, and it's also a Sharia compliant way of placing funds. Now, you may be having this question that why Islamic banks would ask conventional banks to come and place funds in Mudaraba, because Islamic banks would only invest in those assets which are Sharia compliant. So Islamic banks can take the conventional banks' funds and invest them in the Sharia compliant modes of financing, but they cannot do the reverse. They cannot give their own surplus liquidity to conventional banks, because conventional banks would not be complying with the Islamic principles. They would not be complying with the Sharia principles. So what will happen is that when you place your funds with conventional banks, they would place it in interest-bearing securities, and then the return that you are going to get is also going to involve interest. But when conventional banks are investing with Islamic banks, then Islamic banks would be operating based on their own principles, and the returns that they are going to be generating would be Sharia compliant. So that is about interbank pool management. Can we move forward? Yes, we have already discussed interbank pool management using Musharaka as well. The only difference between interbank pool management using Mudaraba and Musharaka is that in Musharaka contract, the underlying contract between the financial institutions would be based on Musharaka. So Islamic financial institution would be inviting other Islamic banks and conventional banks to participate in the Musharaka partnership. An Islamic bank would use the funds which have been pooled to invest in Sharia compliant financing assets. And then when funds generate some returns, then these returns are going to be shared as per the pre-agreed profit sharing ratio. All right, can we move forward? Now, another instrument which is very, very common in Islamic finance, especially in money market, is the commodity murabaha transaction. In this commodity murabaha transaction, what happens is that, let's say there is an Islamic financial institution which is having liquidity management issue. So let's say what it would do is it would purchase some commodities from a broker in the commodity market on cash basis. Now, when the transaction is taking place, it is important that the ownership of the identified commodity is transferred to the buyer, which is Islamic financial institution. That would happen in the second step. In the third step, the Islamic financial institution would sell the commodity to the counterparty on deferred price. So it has bought the commodity from broker A in the commodity market on cash basis, and now it is selling the same commodity but to a different counterparty, not to broker A, but to a different counterparty on deferred price, which is going to be higher than the price at which cash basis transaction took place in step one. So this transaction which is taking place in the third step would be at a higher price, because there is a deferment option involved, deferment of price is involved. So there would be a cost price plus profit margin involved in the second transaction, in which the Islamic financial institution is the seller. Now, in interbank transactions, the counterparty will be the bank requiring short-term finance. So the counterparty is going to be the bank requiring short-term finance. So when Islamic banks require financing, they would enter as the buyer in the third step transaction. And when the Islamic financial institution are trying to place surplus liquidity, they would enter as the Islamic financial institution in the first step. So in the fourth step, what will happen? For the second transaction that has happened in the third step, ownership of the commodity will be transferred to the counterparty so that the sale is completely executed. And then in the fifth step, the counterparty will then sell the commodity to broker B on a cash basis in the commodity market. So the counterparty was not having the need to buy that asset for its own sake. It was looking for liquidity management. It was looking for financing. So what it will do is the counterparty will then sell the commodity to broker B. Now this broker A and broker B have to be two different entities, two different individuals. They cannot be the same. Otherwise, it would become a organized commodity murabaha, which is considered as non-compliant by Islamic scholars and also by OIC Fiqh Academy, which has rendered it Sharia non-compliant. The organized tabarruk or the organized commodity murabaha is considered as non-permissible. So it's important that broker A and broker B should be two different entities, two different parties. The counterparty will then sell the commodity to broker B on cash basis in the commodity market. And finally, the ownership of the identified commodity will be transferred to broker B. So you see, there are three sale transactions involved. Now, I think in the next slide, there is a flow chart of this transaction, which will be even easier to follow. So look at this. Here we have 3 transactions happening, and we have 4 parties, 2 brokers, and we have 2 financial institutions. One financial institution is the Islamic bank, another financial institution is the counterparty. It could be Islamic bank, it could be another financial institution as well. So in the first sale transaction, what is happening is Islamic bank is buying commodity from broker A. So these dashed lines are showing cash flows, and these solid lines are showing commodity flows. So bank buys asset on a spot basis for cash. Islamic bank pays money in cash. Broker A gives commodity to the Islamic bank. Now, then Islamic bank would sell the asset on deferred price basis to the counterparty. So counterparty is getting the asset, but it does not have to pay the price in full. It can pay the price at a future date. So the payment is deferred. The counterparty does not have to pay in spot to the Islamic bank. And Islamic bank is going to sell this asset to the counterparty at a higher price than at which it bought the asset from broker A on cash basis. Now, when the counterparty has got the asset, the counterparty is going to now again sell this asset to broker B, which is a different entity than broker A, and it is also not the same as Islamic bank. It's a different entity. It's a third party. So the counterparty is going to sell the asset to broker B, and broker B is going to pay the price in cash. So the counterparty who was requiring funds has now got cash, which was needed by the counterparty. And the counterparty has this option that to the Islamic bank, it would be paying the price at a future date because of the deferment feature involved. Now that price is definitely going to be higher than the cash price. But what the counterparty has got is it has got liquidity, it has got funds at spot, and it could then run its operations and then generate returns and then pay the deferred price to the Islamic bank. So this is commodity murabaha transaction. If it is done in this way, in a genuine way, it is allowed. But if let's say broker A and broker B are same counterparties, then it is considered as organized commodity murabaha, organized tawarruk, and it is not considered compliant. All right, can we move forward? All right, so when we talk about forward and future sale, Islamic rules of sale allow salam and istisna. So salam and istisna are 2 different, you can say, sale transactions in Islamic finance, which are also known as exceptional sale transactions. Because in salam and istisna, it is allowed that you can enter into a transaction for an asset which does not exist in present time period. So salam and istisna could be, you can say, substitute for forward and futures contract. So for genuine risk management needs, salam and istisna can be used. So for instance, the entrepreneur who has the need for working capital finance, it could use the salam contract to, let's say, sell the commodity and get the full price at a spot, and then do the production or do the expense management from the salam price which it has received. And then when the maturity of the salam contract comes, then it would have to basically provide the commodity to the buyer on the delivery date. Islamic banks providing finance through salam can offset their position by selling the asset in a separate salam contract to any third party other than the original entrepreneur or its associate. So for short-term financing, salam contract can also be used, but there is also an issue in salam contract that when it involves currencies. So in Islamic jurisprudence, it is said that when you are entering into currency trade, you have to have delivery at a spot. You cannot defer the delivery. So when you are entering into the transaction for a gold buying or for silver buying, the delivery cannot be deferred. So because the delivery cannot be deferred, it is said by some scholars, in fact, most of the scholars, that salam in currency is not allowed. But some banks still use it based on some other, you can say, legal opinions shared by a few scholars. So this is one issue in Islamic finance, that some scholars think that Salman currency is allowed, but most scholars do not allow it, because it is in contradiction of uh, the rules related to bayu sarf, which say that delivery of the currency or the commodity which is used as currency cannot be deferred. So when you are entering into gold buying or silver buying, you cannot have a deferment of delivery. You have to have a spot transaction. All right, can we move forward? Yes, in options, we have seen that there are some issues with respect to Sharia principles. So what happens is that in place of options, Islamic finance uses buy or boon. What is buy or boon? It's a type of down payment sale. So it's a type of advance payment or down payment sale, with the condition that if the buyer accepts to complete the sale by taking the object of sale, then the down payment will be treated as part of the selling price. Otherwise, if the buyer chooses to resign the sale, then the advance money will be forfeited. So what happens in call option is that if you decide not to exercise the call option expires, and you do not get back the call price. So same is the case with buy or boon. You have to make a down payment or advance payment, and based on that, your price is locked. Now, until a certain time period which is allowed for you to make the full payment, if you do not make the full payment, and if you, let's say, resign the contract, if you say that you want to back out of this contract, then you would forfeit the advance money that you have paid. So this is one option which can be used in place of options contract. Buy or boon can be used. And in place of interest rate swaps, Islamic finance suggests that if you, let's say, want to hedge against the interest rate risk or the benchmark rate risk, what you can do is you can enter into variable rate benchmark as the pricing for the financing contract. So when you are doing a lease contract or a diminishing musharaka based mortgage contract, if you want to, let's say, manage the interest rate risk or benchmark rate risk, you can go for variable rate benchmark with a certain cap and floor, rather than having to go for interest rate swaps. So in place of interest rate swaps, variable rate benchmarking with a cap and floor can be used to manage the genuine uh, risk management risk. So Islamic principles say that if you, let's say, want to manage your genuine risk, you want to hedge your risk, then there are certain options available. But if, let's say, the objective is just to speculate, just to gamble, and just to make a short-term money out of somewhere, so Islamic principles would not have solution for every conventional financial instrument. But for the genuine risk management needs, we have seen that there are enough instruments available to facilitate the Islamic finance industry. Can we move forward? Yeah, I think I have also discussed that. Can we move forward? Yes, so this is going to be my last slide, in which I would try to summarize that what are the issues in liquidity management in Islamic finance right now. One issue that comes is that Islamic finance does not have its own interbank benchmark rate. It does not have a distinct interbank benchmark rate. It uses LIBOR, or now after the LIBOR has been phased out, it uses other instruments benchmark rate, like for instance SOFR in USA, Sonia in the UK. But it does not have its own benchmark rate. Why? Because it does not have a systematic importance in most of the bigger markets. So Islamic finance is just 1% of the total uh, finance industry that we have in the world. And in different parts of the world, the share of Islamic banking is still, let's say, less than 10% in many countries, and not more than 30% in other countries. Very few countries have more than 30% market share. So what happens is that the central bank and the regulators and the governments, they also do not feel that it is appropriate at this time to have a distinct Islamic benchmark rate. But yes, in countries like Malaysia, where we are having almost 50% market share. We are seeing that Islamic benchmark rate is also developing. Another problem in liquidity management in Islamic finance is that there is lack of Sharia compliant alternatives for liquidity management, both at the interbank and at the central bank level. So central bank also has a role in money market because it uses the money market instruments to basically execute its monetary policy. It uses the open market operations to basically manage the money supply and then manage the interest rate through it. Now, if let's say it does not have enough money market instruments which are compliant with Islamic principles, then there would always be apprehension when the call for complete transformation of economy or complete transformation of the financial system is voiced. So that is another issue which is faced in Islamic finance right now. Absence of liquid Islamic sukuk. So sukuk are usually not issued in the secondary market. They are not available for secondary trade. Most of the sukuk are not available for secondary market trade in many countries. So in that case, they are not as liquid as, let's say, Treasury Bill or let's say other conventional money market instruments. And then most of the sukuk would also have medium term maturity. So they do not have long term maturity, and they also do not have very, very short term maturity like Treasury Bill. Absence of Islamic discount window at central bank, that is also a problem. Conventional banks, when they have hard times, they can go for the lender of the last resort facility. But Islamic banks in most countries do not have this lender of the last resort facility. In liquidity management, banks often have surplus liquidity as well as shortage of liquidity. This problem becomes more pressing as there are lesser alternatives for managing liquidity shortage for Islamic banks. So when they have liquidity shortage, Islamic banks, when they have liquidity shortage, they cannot borrow from the conventional banks because interest is involved. An Islamic bank can take investment from any financial institution and invest in Sharia compliant financing assets. However, it cannot invest its surplus liquidity on equity financing basis with conventional banks, since they are operating on the basis of interest based loans. So these are some of the issues in liquidity management in Islamic finance right now. I think I have talked enough. If there are any questions, I would be willing to answer. Thank you.
Yes, thank you very much, Dr. Salman, for this wonderful discussion, mashallah. So now we open the floor for any questions or any additional remark or points from the online guest. So either you may raise your hand or you may write your questions in the question box. Okay, I think yes, there is someone, Rashad Zaidan. Okay, brother Rashad, Dr. Rashad Zaidan. Welcome, please. Yeah.
Assalamu alaikum.
Alaikum assalam wa rahmatullah. Yes.
Thank you very much for this very good lecture. I just want to get the help from the doctor to give us some names of the Islamic banks which we can deal with in United States or in British country. Thank you very much.
All right.
Yes.
Very good question, and it's a question which many people, especially those who are living in UK and USA. Give me a second. I would just like to mute this.
Yes, please, doctor. Okay, if anybody else also have any questions or any additional point, please raise your hand or you may write your questions or remark in the question box. Meanwhile, waiting for Dr. Salman to state some names of the banks, Islamic banks in UK and US. Okay.
All right, can you hear my voice?
Yes, yes, doctor, please. Yeah.
Yes. In UK, we have five full-fledged Islamic banks. So this is very good news that in England, at least, we have five full-fledged Islamic banks operating. Unfortunately, I do not remember their names, but you can look up, and I'm sure that they are still operating. And customers who want to avail, let's say, Islamic mortgage or want to have Islamic bank account, they can use these full-fledged Islamic banks which are operating in the UK market. Now, USA is different. USA has apprehensions about Islamic finance. Actually, what happened was that in 1970s, when this movement for Islamic banking was gaining momentum, there were some political issues involved as well. So the USA market has always been very apprehensive of Islamic finance. They also raised this issue that maybe Islamic finance is a way to just manage the funds flow to different prohibited segments. Like for instance, they had this apprehension that it might be used for terrorism financing, it might be used for money laundering. So they always had this apprehension. That is why USA market has not been very welcoming towards Islamic finance, even though Islamic finance now has recognition and has presence in the European market for sure, but still the USA market is very small. There are some institutions like guidance, like La Riba, but they are operating at a very small scale, and they are not operating as full-fledged licensed banks. So I would advise caution while dealing with certain institutions which are not recognized as banks as such. USA market is very flexible in the sense that it allows non-banking financial sector companies to operate as well. But to Islamic finance, yet they have not allowed full-fledged Islamic banks to operate, and that is why there is this issue faced in the USA market at least. But in UK, we have seen that England have issued sukuk. They want to be center of Islamic finance. They want to be hub of Islamic finance. Likewise, France, Luxembourg, and many other countries have given tax neutrality to Islamic finance transactions. So they have recognized Islamic finance transactions. They have been providing a level playing field. In UK, we already have full-fledged Islamic banks, but in USA, yes, the options are limited, and especially when it comes to full-fledged Islamic banks in USA, still I think there is a long way to go because of not having any weakness in Islamic finance or Islamic banking, but because of certain political apprehensions, Islamic finance has not taken a major step in USA yet.
Okay, thank you, doctor, for this clarification and for the information. Doctor, there are three questions, if you may briefly respond to them. What is the difference between SWAMP and Mokasa system? And number two, when is it permissible to transact the sukuk certificate? And number three is it permissible to transact the sukuk certificate before the sukuk project is done?
All right. Can you repeat the first question? What is the difference between sukuk and which instrument?
Between SWAMP and Mokasa system.
Mokasa system. The issue with swap is that usually when it is done in interest-based liabilities, the debt is exchanging at a different price. So when debt is sold at a different price than the par value, then riba is involved. And the underlying instrument which is being traded in interest rate swap is also an interest-based transaction. So interest rate swap is not compliant based on multiple reasons. The underlying contract is not Sharia compliant, and then the the contract of swap is also involving debt sold at different from par value, so it is not compliant. Whereas the alternative that Islamic finance offers, like Malaysia has come up with the Islamic swap agreement. So in that they have tried to include a underlying transaction which is Sharia compliant, and then because some asset is involved, it is possible that when you trade assets, then the asset price could be different in different contracts. But when simply a loan of money is exchanged, so then it would be exchange of money with money, and if it is done at a different price than par value, it would involve riba. So if the questioner was uh, referring to the Malaysian experience of Islamic interest rate swap, it is Sharia compliant. But even then, some Islamic scholars would have issues with some of the instruments which are very much common in Malaysia, like for instance the instrument of tabarruk or the instrument of ina. Some scholars have reservations on ina and tabarruk transactions, which are very much common in that part of the world, in Malaysia. So it is important that the underlying instrument should be Sharia compliant, and it is also very important that when the swap is executed, then the underlying contract involves debt exchanging at a different price than par value. So that makes interest rate swap as Sharia compliant.
Yes, Dr. Salman, we cannot hear your voice. Dr. Salman, I think your microphone is off.
All right.
Yeah, yeah.
All right. So interest rate swap are not allowed because of two reasons. The underlying contract is not Sharia compliant, and the debt is exchanging at a different price than par value. So that makes interest rate swap as Sharia non-compliant. Now, the Islamic interest rate swap, which is offered in Malaysia, uh, it involves underlying Sharia contract, which is at least in that part of the world is considered Sharia compliant. And it also involves certain assets. The transaction involves certain assets. So because some tangible assets are involved, the contract can have a different price in different legs of the transaction. But if let's say only money loan is getting exchanged and substituted, then it cannot be exchanged at a different price than the par value. So Islamic interest rate swap would be considered as Sharia compliant, but still some scholars have reservations with the underlying instrument. Like for instance, some scholars are apprehensive of tabarruk, they are apprehensive of bay'ina, but the Sharia scholars in that part of the world are giving, let's say, legitimacy to these contracts under certain conditions. So in that part of the world, yes, under certain conditions, under their framework, the Islamic interest rate swap is considered as Sharia compliant. But interest rate swap cannot be considered as Sharia compliant because the underlying contract involves interest rate loans, and the contract of swap involves the debt exchanging at a different price than par value. So I hope this answers the question.
Thank you. Thank you, Dr.
The
Salman.
third question,
Is the
yeah, the
sukuk
third question was
transaction?
about, yeah, yeah. In the sukuk transaction, in Morabaha sukuk, scholars say that you cannot have a secondary trade. You cannot have a secondary trade in Morabaha sukuk. This is the view of some scholars, but some scholars also say that it can be done. The secondary market trade can also be done. Those who say that it cannot be done, the secondary market trade cannot take place, they have this reason that when Murabaha transaction has taken place, only the payment is you know is deferred. So the transaction has executed, only the payment remains. Now, when you are then having a secondary market or trading of Murabaha Sukuk, you are basically trading on the liability which is remaining from the Murabaha. And when you are trading this liability, you cannot have trade at a different price than par value. So that is why some scholars have this opinion that secondary market trading of Murabaha is to be avoided. But when it comes to Ijara Sukuk, Istisna Sukuk, mudaraba sukuk, musharaka sukuk, it is possible to disinvest your investment at any point, because when you are disinvesting, you are basically selling the part of the asset that you own to someone else. So it is allowed that if you own an asset or part of your asset, you can sell it at any time. In fact, in diminishing musharaka, we do it all the time. We have a shirkatul milk, and then each installment that we pay, we buy a certain part of the unit of the bank. So sale transaction can always be done when, let's say, an asset is involved. So in ijara sukuk, musharaka sukuk, mudaraba sukuk, istisna sukuk, there is no problem of secondary market trading. It can be done at any time. It is not necessary that when you invest in sukuk, you have to keep it until maturity.
Okay, thank you very much, Dr. Salman. Jazakallah khairan. Barakallah fiqh. Okay, online guest, our honorable participants, thank you very much for joining us in this important session. We believe that you benefited, and as we benefited from this very important and excellent session discussed by Dr. Salman Ahmed Sheikh. And we thank you very much, Dr. Salman, for your valuable time and for your effort and for providing this excellent presentation and discussion. And may Allah bless you, and nasallallahu subhanahu wa ta'ala yubarik sa'ya wa yanfa'a bikal Islam wal Muslimin. Inshallah, we hope to see you again in upcoming any other session, inshallah, very soon. So we thank our management, board members of Nadal Iqtisad al-Islami for their effort and for their hard work and services to promote these Sharia compliant modules and strategies globally. So we thank you very much as well. Inshallah, we will see you again in upcoming sessions very soon. With that, we conclude today's session here. Subhanakallahumma bihamdik. Ashhadu an la ilaha illa ant. Astaghfiruka wa atubu ilayk. Assalamu alaikum wa rahmatullahi wa barakatuh.